Most new investors repeat the same costly mistakes without realizing it. In this video, you'll learn 7 of those mistakes and clearer ways to approach your investing. Mistake number 7 is the one almost nobody talks about, so make sure you stay until the end. Quick disclaimer: this video is for educational purposes only. This is not financial advice. Mistake number 1 is investing with no emergency fund. If your car breaks down, you lose your job, or you get a surprise bill, and you don't have savings, you'll be forced to sell your investments at the worst possible time. You buy high, life happens, and you sell low. What to do instead is build a small emergency fund first, enough to cover a few months of essential expenses. It keeps real life from ruining your long-term plan. Mistake number 2 is chasing hot tips. A friend, a coworker, or social media tells you something is guaranteed to explode and you don't want to miss out. But by the time the average person hears about a trend, it's often too late. You end up buying because of hype and selling because of fear. A better move is sticking to simple, diversified investments, things that spread your money across many companies instead of betting everything on one. If that one sounded familiar, the next mistake is even more common. Mistake number 3 is trying to time the market. You wait for the perfect day to invest, or you jump in and out based on headlines. But nobody, absolutely nobody, can predict every up and down. Beginners who try usually end up doing nothing for years, or they panic sell right before things rebound. Instead, invest consistently. For example, setting aside money each month automatically. When prices are high, you buy a little. When prices are low, you buy more. Over time, this smooths everything out. Mistake number 4 is putting all your money in one place. Maybe it's the company you work for. Maybe it's one industry you believe in, or one country you feel safe with. But if that one thing drops, your entire net worth feels it. Diversification is the fix. Spread your risk. Think of it like having many smaller baskets instead of one giant one. Mistake number 5 is ignoring fees. A fee of 1 or 2% might sound tiny, but over decades, it can quietly drain tens of thousands of dollars from your future. 2 people can earn the same returns, but the one paying higher fees ends up with dramatically less. Choosing lower-cost investment options whenever possible is one of the simplest ways to keep more of your own money. Mistake number 6 is investing with no clear goal. You invest because you should, but you don't know whether the money is for something in 5 years or 30 years. Without a goal, you either take too much risk or not enough. Ask yourself, what am I investing for? When will I likely need this money? And how comfortable am I with short-term ups and downs? Your answers guide your entire strategy. Mistake number 7 is constantly changing your strategy. You start with one plan, see a scary headline, switch to something else, get influenced again, switch again, and you never stick with anything long enough to let compounding work. Think of your investment plan like a tree. If you keep digging it up and moving it every few weeks, it never grows roots. Even a basic plan followed consistently often beats a perfect plan that you keep abandoning. What to do instead is choose a simple strategy you actually understand. Automate your contributions and review things only once or twice a year, not every time the news tries to scare you. You don't need to be a genius to invest successfully. You just need to avoid these beginner traps, stay patient, and focus on the long term. If you do that, you give your future self a much better chance of having stability, options, and peace of mind. If even one of these tips helped you, please like and subscribe for more.